Well, it's been interesting to watch because he certainly has his own opinion on things, and he's not necessarily following what the administration necessarily wants him to do. But he's also reacting to what appears to be increased growth in the United States and a concern potentially over inflation, and indicating that he's going to raise interest rates is obviously causing some volatility in the equity markets. What we haven't seen thus far is any volatility in the debt markets. The primary market for debt is still incredibly strong in the U.S. The secondary market trades at a very high price. So we haven't seen that leak in yet. It's going to be interesting to watch if his moves over the next year start to cause some trouble in the debt markets.
So is he the big elephant in the room who's potentially triggering the debt market to have more volatility?
Well, the answer is we always look at what causes cycles in the debt market in hindsight. It always is obvious in retrospect. But the answer is on the front end of it, we never really know what causes it. Certainly that's a factor. There's geopolitical risk. There's U.S. political risk. Again, in hindsight, it always seems obvious, but with foresight, it's very difficult to tell. The answer is we have a lot of debt outstanding in the United States right now. The market's been very strong for a very long time. We watch it very closely, and when it starts to break down, that's when we can attack.
Yeah, let us look at a scenario when it starts to break down, because many people are saying this could actually get really nasty because the level of debt is so huge. What's the comparison to 2007?
Yeah, well, there's almost twice as much non-investment grade debt outstanding today as there was in 2007. It's about $2.4 trillion. There's over $190 billion of CCC paper outstanding, so it's significantly higher than back then. It's just a question of what the trigger is. So the kindling for the fire is there. It's just a question of what the trigger is.
Elsewhere in the world, we also have huge volume of non-performing loans, for example, in China. And there is some sort of movement that investors are also allowed to put their money at work there. So how interesting is that?
Well, I run a U.S. distressed private equity strategy, so it's not for my strategy. Certainly at Oaktree, we have pockets that look at emerging market debt. China is definitely an interesting place, but also a very difficult place to invest.
Okay, let me bring you back to the States then. Do you see which industries are most likely more interesting in the foreseeable future?
Yeah, we're relatively agnostic to industry. We're more of a bottoms-up investor. Retail, from a distressed thematic perspective, retail is obviously the distressed du jour right now. Very difficult industry to invest in. It's more of a melting ice cube play than anything else, so it's really something we've avoided in our strategy. Oil continues to be another industry that's relatively distressed, although it's come back a lot with oil prices improving. But again, for me, we spend our time really looking at businesses as opposed to underlying industries.
Let me bring you back to the macro environment, though, because everybody's sort of waiting for the bond bubble to burst. Do you think that this is going to start off in the States?
It wouldn't surprise me if it started off in the States, because I think the aggressive nature of debt issuance over the last really 10 years since the financial crisis is such that you have a very full market with a lot of fast money that's invested in debt between the CLOs and the ETFs and the other sources of capital. So it wouldn't surprise me. I mean, we did have a window in late 2015, early 16 that was short, where the entire market traded down. It created a lot of opportunity. It snapped back very quickly in March of 16. So you can see that happening again. Again, it's just a question of what triggers that.